So the trust positioning is very consistent with what we said in our IPO prospectus, which is that we will invest in a diversified range of technologies to help transition to net zero. I think what we've reflected on since the trust IPO'd in October 2020 is that the name doesn't reflect the underlying mandate, and so we are in the process of consulting with our shareholders to change the name of the trust to better reflect the mandate that we have, the investments we've made to date, and the investments that we expect to make in the future. And really, our positioning is focused always on these three main pillars that we always talk about with TEEC. First of all, to focus on the supply side or the generation of electricity to make sure that is decentralized and close to the centers of demand and lower carbon. So, for example, in run-of-river hydro assets or solar farms. The second core plank of our investment thesis is to invest in the distribution and flexibility side to help better match supply and demand. And the final pillar that we've always focused on has been the demand, which is about reducing demand, for example, behind the meter. So that could be rooftop solar panels, it could be LED lighting to reduce absolute levels of demand. And those are the three key tenets of the trust that have been there since day one. The underlying assets in the trust have performed really, really well, reflecting the attractive conditions for energy generation assets. Our CHP assets have experienced revenues double what we expected them to be at the point of investment. EBITDA has also been significantly ahead of budget in those opportunities, in those assets as well. Our hydroelectric assets have had a very strong start during our ownership period, with availability, revenue, and EBITDA being ahead of our forecast at the point of investment, albeit it is early days. Overall, the trust itself has seen underlying NAV growth in the assets of in excess of £3 million, reflecting the higher inflation environment and higher future expectations of power prices going forwards. We've recently announced investments into battery energy storage and LED lighting. Battery energy storage has a crucial role to play in balancing supply and demand, and that's why we're really pleased to do our first deal backing an operator called Field with around £45 million of debt capital this year. The debt will be used to build out 4 battery storage assets spread across the length and breadth of the UK in Wales, Scotland, north and south of England. There'll be 1-hour and 2-hour systems, backed with EPCs from UNESCO and leading cell suppliers. The assets will earn revenue through an offtake with Statkraft over a 10-year period, Statkraft being an investment-grade Norwegian government-owned energy company, which we think provides a really attractive revenue story for these assets. And we've been really pleased to be able to provide debt into this important asset class because there isn't a sufficient amount of debt capital available to energy storage asset owners and operators to build out their pipelines in our view. And typically, banks have not been willing to lend sufficiently and in a correct structure to this important segment. So we tailored a debt structure, a unitranche debt structure, to enable this deal to happen. It was something completely new in the sector and something that we're really proud of. We're also proud of the ESG protections we put in place, whether that's the ESG margin ratchet, which encourages trading to maximize the carbon benefit of the assets, or whether it's the end-of-life protections around ensuring that the lithium-ion cells are recycled. So we've really put some, we think, market-leading ESG credentials in our loan agreement to really ensure that this aligns to our investors' ESG requirements. We've also invested in LED lighting at a leading logistics company to help them reduce their carbon footprint and save them energy costs at a time of high energy prices. So I'll focus on our hydroelectric power assets. We own 9 of them in the Highlands of Scotland. These assets have some really attractive revenue components, and we think have some really exciting ways we can increase the value of these, both from a carbon and a performance perspective. Starting first of all with the revenue story here. The assets benefit from the feed-in tariff, which is a government-backed subsidy to provide income for every kilowatt hour of generation, as well as a floor on the price that power is sold at. This provides real stability in earnings to our investors. And it is easy, of course, to forget that there were negative power prices briefly in the UK over 2.5 years ago. And so having that stability enables us to pay a very sustainable and predictable dividend to our shareholders. In addition, the rates that we receive are indexed by the retail price index each year. At a time of high inflation, having strong inflation protections backed by government contract is really attractive for our shareholders as well. And finally, we've been able to take advantage of power purchase agreements or PPAs to maximize the value of the revenue that we have through taking advantage of the current market conditions of high energy prices to lock in good rates of return for our investors. On the ESG side, we have used natural capital solutions to improve the performance of the assets through restoring peatland. This slows the flow of water into the intake, providing higher levels of generation and therefore revenue to our investors. And through restoring the peatland, which acts as a carbon sink, we're able to sequester more carbon and have a stronger environmental impact through this investment as well. A key theme in order to get to net zero is going to be around having a holistic approach. You can't just focus on the supply, for example, of energy and just build lots of solar farms and wind farms because, of course, it's not always sunny and the wind doesn't always blow. You've got to have battery storage and a proper distribution network in the country. But you've also got to recognise that there's got to be demand reduction. We've got to reduce the absolute consumption of energy in order to get to net zero, given the intermittency of renewables. And so a holistic approach is going to become even more important. Over the past 24 months, we've been really pleased to see lobbying and pushing of the government to invest in energy efficiency to reduce that demand. But it is the often overlooked part of the transition to net zero. And so we think that's a really important theme that's going to grow. We think private capital has a really important role to play, particularly given the government hasn't provided significant levels of investment to try and achieve that. And we're really excited by the opportunities that we see there. We're seeing lots and lots of corporate counterparties come to us looking to install generation equipment on their own premises, whether that be rooftop solar or CHP, for example. That will significantly reduce their bills, which is obviously really important, but it will also improve the carbon credentials and reduce their carbon footprint. So that's a trend we're typically seeing. And back to the point around balancing the grid, the demand for battery energy storage is rapidly growing. We see that as being a significant part of how we can help facilitate a transition to net zero. Last year, there was enough energy wasted from wind alone to power 1 million homes. That's a staggering amount of waste of energy. We've got to do better by putting in flexible assets on the system. That's what battery storage can do. And we see that as being a key theme. When these intermittent generation technologies such as wind and solar are producing power, we can't afford to waste it. We've got to save that energy and use it and sell it back to the consumer at a point in time where it's really needed. And that's what we think we'll be able to do through battery storage investments. So those are some of the key trends that we're seeing in the moment. The final broader requirement that we're seeing from our investors is to make sure that they understand how their investments are protected from increasing inflation. Now, we have two sort of levels of inflation protection within our fund. First of all, the broader fact that energy prices and inflation are correlated. They tend to move in line with each other. And so investing in energy is a good way overall to protect oneself from inflation, and even in some cases to benefit from inflation through higher prices. However, the other more explicit way we benefit from higher inflation is these government-backed contracts that I've talked about, and also agreements with off-takers to effectively increase the price that we get in line with RPI each year. And that again provides really strong inflation protection for our investors at the current time.